Hi, everyone. We're talking about, of course, Ind AS 8, which is accounting policies, changes in accounting estimates and errors. As you observe that the past examination trend, the new syllabus has not tested it since last four attempts up to November 2019. But what we want to also highlight is that this is an important theoretical paper, important theoretical standard. So we need to be absolutely comfortable understanding the differences between these two terms and when we look at the changes or the corrections, for example, then how are these changes or corrections required to be brought into account? Because one way or the other, this standard is being used for other standard references also. We talked about in the introduction framework, we talked about the changes in the useful life of an asset, right? So that would have a consequence directly in the accounting for property, plant, and equipment, or investment properties, or you know intangible assets for that matter. So you start looking at that, right? Similarly, you look at the provision for warranties, if changes in those, etc. Then how do you bring that along? Is again, impacting the accounting under Ind AS 37, which is provisions, contingent liabilities, and contingent assets, right? So let's start our journey. We talk about, of course, the accounting policies. And when I say accounting policies, I intend to explain that, or understand that all those conventions or rules or practices or specified principles or base which are applied by an entity while preparing and presenting these financial statements, right? You would remember we talked about the assumption of accrual, right, under the framework guidelines. We talked, of course, about the prudence concept, right? We talk about the matching principle, right? We use all these aspects, right? We use all these aspects while preparing the set of financial statements under accounting framework, right? But then we also want to now highlight is that there could be some choices that are available under different accounting standards, right? Could be choices which are available under different accounting standards, which we can select while preparing and presenting the financial statements. Okay, so it becomes a little more comprehensive. It becomes more, inclusive in terms of knowing what is an accounting policy. The definition is not just confined to specific rules, but it will cover a broader perspective when we look at accounting policies, right? So again, the argument that comes is, what if the choice is not available? Then where do I go? That's what we're discussing under the introductory session as well. We'll be talking about that now, right? So just to highlight this part, that different accounting standards would have different policy choices available. For example, you may have a choice under Ind AS 116, right, where you may not want to, let's say, avail the exemptions as far as the short-term leases or the low value leases are concerned. So you can continue to recognize and measure those contracts also as per normal lease arrangement. Similarly, in terms of the government grants, Ind AS 20 gives you a choice whether you want to show these grants as a part of deferred income, or you can reduce them from the cost of the asset, for example. So you have those choices. Similarly, there can be choices with respect to the investments in terms of how do you measure those. Ind AS 109, for example, we'll talk about that. You may also look at the policy choice with respect to the revenue recognition. So Ind AS 115 would address that, right? We talked about, of course, Ind AS 2 specifically, we look at the inventories, valuation. So let's put it here. Similarly, we had property, plant, equipment, and intangible asset, where you have a choice of showing the asset at at the cost, or the revalued amount, right? So we have those choices under Ind AS 16 or 38, right, as the case may be. So what I'm trying to highlight is that there are multiple such examples that would come across where you look at accounting policies. normally the accounting policies choice are available through the standards. That would be an easier job for us to follow, right? But then practically it could be difficult to always find those answers there. Okay, find those answers within the Ind AS. Okay, now as far as the Ind AS governs that accounting policy, we don't have to go any farther. That's an easy job, right? And then the Ind AS with the core standards are also supported by the guidance. Even that guidance is compulsorily used. We don't have a choice on picking those guidance or avoiding those guidance per se. So what I'm trying to say is that the first step that we look for as far as the selection and application of accounting policies are concerned is the Ind AS itself, right? The list of the examples that we talked about is a clear reference from the Ind AS perspective, right? But then what if the Ind AS is not present? Okay, what if the Ind AS is not present? Then we say try to have that true and fair view, but then this could be a very vague statement. This could be a very open statement, right? But then still the focus goes on that in case the Ind AS is not present in terms of what kind of policy choice we should have as far as the application to a particular transaction is concerned, then the management is required to use its own judgment in developing and applying an accounting policy that would result in relevant information and reliable information. Again, you go back to the conceptual framework to understand all these aspects, right? There should be a faithful representation. It should represent the substance. It should be neutral. It should be prudent. It should be complete. All these key attributes are critical for an entity to, for example, build an accounting policy choice, right? So in case, of course, the Ind AS do not specify anything. Okay, I mean, the easier example for me to probably talk about in today's time is as far as the insurance industry is concerned, right? So, and that's a complex industry for sure. So there's no clear Ind AS available, and even the the Ind AS 104, which is available for insurance contracts, that is going to be redundant. So what we are talking about, and that's not a complete standard in itself, by the way, it's more of a transitionary standard, right? So in case there are some transactions that an industry, an insurance company is facing, where they don't have a clarity in terms of, what kind of accounting policy choice do they make. So that is where you don't see the Ind AS in place, and accordingly they need to take into consideration all these aspects to be able to, let's say, build that accounting policy there, right? So we are saying go for the Ind AS and the guidance first, and then if it's not available, then you go to the conceptual framework. Okay, that's something which is expected to be done, but then that's where the entire procedure that comes into the picture, we need to be very, very comfortable with, right? Look for the Ind AS and guidance first. If that is not available, then you go for the conceptual framework while taking a judgment as far as the development or application of an accounting policy is concerned. All right. What we also want to say is that if, for example, sorry, if, for example, I have an accounting policy in place, can I change the accounting policy? Right. Now, there are two aspects to look at it. One is I don't have a choice because the Ind AS itself wants me to change it. Right. Then you have to change it. There's no choice about it. But then if you believe that the change in accounting policy is going to result in more reliable and more relevant information, then you may do so. Okay. So one aspect is no choice, but to do it mandatory. And then the aspect is, of course, the choice is available. You have some flexibility. If you believe that And you have to prove why do you believe it, right? If you believe that the change in accounting policy is going to result in giving reliable and more relevant information for the intended users, right? So yes, to answer the question, can I change the accounting policies? The answer is yes. Okay. And then we start moving farther around it in terms of how do we look at that change from the accounting policies perspective. What you want to remember here is that we give a high regard to the comparability framework. Okay. Put it simply, any statement or any financial statements that we prepare balance sheet, statement of profit or loss, statement of changes in equity, statement of cash flows and disclosures, we are not only giving the information for the current accounting period, but also for the previous comparable accounting period, right? We understand that well. Now, why is this required to be done? Because people can make a comparison and they can evaluate how is this company's performance and the position vis-a-vis the corresponding accounting period, right? So the last thing that you expect, is basically that you have one accounting policy being used in the previous year or the previous accounting period versus a different accounting policy being used in the current year, right? That simply, what do you say? That simply deviates the objective of comparability. That simply kills that very purpose of comparability. Okay. So while we were saying that, yes, you can change the accounting policies, right? You're allowed to make a change in the accounting policies. The question of comparability remains there. And that is where we say, importantly, in case of change in accounting policy, right, the impact has to be done in the financial statements retrospectively, right? On a retrospective basis, you practically go back to the earlier period to have this accounting policy applicable even for that. Okay. So if you're preparing comparative financial statements for this year versus the previous year, or maybe for 2 further years, then the accounting policy change has to be made for all comparative periods. You don't have a choice around it. Okay. That is something that you want to consider when you are preparing the sets of financial statements and changing the accounting policy, right? This would be, of course, required to be done when you are changing that accounting policy, when you believe that this is going to result in a more relevant or a reliable presentation. Okay. However, if you look at a mandatory requirement, just because the Ind AS have been changed, right? In case the Ind AS have been changed and you are compulsorily required to change the accounting policy. Okay. In that case, the standards give you a transition provision in terms of when can you start, right? At what point in time are you supposed to start from the change in the accounting policy? The transition provision might say you don't have to go to the previous year, right? Or transition provision may say you have to go at the earliest period, could be 5 years ago, could be 10 years ago, right? So you need to be careful about it, whether the change made in the accounting policy is a voluntary change or is it a mandatory change. A voluntary change necessarily requires you to go retrospective, but a mandatory change would be routed through the transition provision. All right. The one thing that you want to remember categorically here, that in case of changes in valuation of property, plant, and intangible assets, right? We do have a choice within the accounting standards of Ind AS 16 and Ind AS 38 respectively, that you can use either a cost model or a revaluation model. So in case I change that method of valuation, right, that is one specific category of transaction where we are not permitted to go retrospective, where we are not allowed to do a retrospective calculation. Okay, that's something that you want to remember here at this point in time. In general, you do retrospective, but as far as the changes in the valuation method of a property, plant, equipment, or intangible asset is concerned, you are not allowed to do retrospective. Of course, you would do a disclosure of that a change in accounting policy has taken place, but you don't do it otherwise. Okay. Something that we have discussed, of course, any case of changes in accounting policies, if the Ind AS required to change, then normally they would give a transition provision and you have to use the transition provision, right? Rarely there would be no transition provisions issued, then you obviously have no choice but to go retrospective. So is the case with the voluntary changes also. You have to make these on a retrospective basis, with one exception. We look at the change in the valuation method for the property, plant, equipment, and intangible assets, right? Now, when you say retrospective application, we are simply saying that entity shall adjust the opening balance of each affected component of equity for the earliest prior period presented and other comparative period as if the new accounting policy had always been applicable. That's what is basically the literal meaning of retrospective also. Okay, so you need to really go back and make those changes in your financial statements for each comparative period, right? And then we start asking, what if it is impracticable? Okay, what if it's not possible to really go back? Maybe the data is lost, maybe the records are not there, right? Maybe the appropriate calculations would require a significant cost and you don't see a cost benefit analysis about that, right? Then you're doing the changes to the extent of the earliest period for which this retrospective application is practicable. And then you're also saying the comparative information needs to be changed prospectively again from the earliest date practicable. Okay. The standard does not define practicability straightforward, but it could be understood that it may not be feasible or possible for the entity to really go back because the data is lost or the records are destroyed, or there could be a, let's say, unforeseen, unexpected contingency that took place because of which information can practically not be retrieved, right? So when you look at all these aspects, then you see that it's not practically possible to go back, right? It's not practically possible to go back, and that is where you start looking at bringing those changes from the earliest possible period. Okay, there are several examples that we can look at and try to understand in terms of how to bring this on a practical framework in terms of the changes in accounting policies. Let's have a look at it. It says that Reliable Limited is in the business of trading of sports shoes. The company has been preparing its financial statements under Ind AS from its incorporation. For its inventory, it follows a weighted average cost under Ind AS 2. In the current year, which is 1920, Reliable Limited is thinking of changing its valuation to FIFO method as it reflects the pattern of actual sales and gives a more reliable and relevant information. So it's a voluntary change we are talking about, and the objective of reliable and more relevant information is achieved. So yes, they have a choice to bring this change. It also says Reliable Limited have been providing 1 year comparative, right? The purchase invoices include freight and other direct costs. Opening and closing inventory are such that latest invoices for the respective years can be attributed to them. Other incidental expenses are not material. The question is whether Reliable Limited can change its accounting policies as far as the inventory valuation is concerned. Now, put it straight, yes, because the entity believes that doing this change, moving from a weighted average to a FIFO method would provide a more reliable and relevant information for the user. So yes, Reliable Limited can very well change its policy for inventory valuation. Now, if it does, then what happens, right? We are saying that, so this is basically year 1920, okay? So for 1920, whatever are the financial statements that you are preparing, right? And of course, the relevant ones would be the balance sheet and of course, the statement of profit or loss, right? So they would undergo a change. With this change in the accounting policies, both the opening and closing inventory need to be remeasured using the FIFO method. Then it doesn't stop here. Even for the previous accounting year, 2018-19, the balance sheet and the statement of profit or loss, and then the opening and closing inventories, they would also undergo a change using FIFO method, right? That is something which is expected to be done. But then, importantly, the opening inventory of 2018-19, right? The opening inventory of 2018-19 is indeed the closing inventory of 2017-18, right? So that also needs to, for example, undergo a change. But then this could be a continuous exercise since many years. So how do you deal with that part, right? In that context, when you see that this changes for a longer period, for a period beyond the comparable or comparative financial statements, we say that also prepare an opening balance sheet for the earliest comparative period. Prepare the opening balance sheet for the earliest comparative period. Now, my earliest comparative period is 1890, right? Of course, it ends on 31st of March 19, and my current year ends on 31st of March 20, right? So if this were the comparative period, which is 2018-19, the opening balance sheet date will be dated 1st of April 2018, right? It will be dated 1st of April 2018. And we are saying that you also need to prepare, importantly, an opening balance sheet as on this date that takes into consideration the cumulative impact of the change in the inventory valuation for all the earlier accounting periods. Okay, so let's say for the sake of argument, if 2010 was the year, which was the date of incorporation, what does it mean? It means that since 2010, the opening and closing inventory have been valued at weighted average, but you need to now bring them all at FIFO. Are you going to prepare 10 such balance sheets and P&Ls, etc.? The answer is there is no such requirement. Ind AS does not expect you to be doing that. It's too much of an effort. But yes, you are expected to then prepare an opening balance sheet as on 1st of April 2018, right? Which gives or which takes into consideration all these changes. And you can imagine what could have all happened, right? The two areas where you see the change, apparently here, the one area would be the inventory. And the second area is because of the changes in the valuation of inventory, very likely the retained earnings would have gone affected, right? So when you see this, effectively you are bringing a revised balance sheet, which is the opening balance sheet on 1st of April 2018, which adjusts all those changes since last 8 years, starting 2010. Okay. And that is something which is expected to be done. And then we also talked about briefly, what if you can't go really back to the date of origination? Then we say probably look at the earliest date, right? Check the earliest date when you can do this particular change. Okay. And that's what is basically expected to be discussed as a part of the solution. We are saying that based on the facts of the case, Reliable can apply the changes in accounting policy, of course, retrospectively. Okay. So the proposed change will not, of course, any change in the purchases, but it would impact the inventory and the movement of inventory, which was recognized in the profit or loss account, which basically is your eventual profit, which is coming into the balance sheet in the name of retained earnings, right? And when you do that, right, you're looking at all these aspects that your year ended 19 would be revalued under FIFO. The last year's balance sheet would also be reviewed under FIFO. And along with that, you would start looking at the changes being brought on the opening balance sheet date as well. So that's where you're looking at the retrospective adjustments. This opening balance sheet would bring the differences in the inventory valuation for the cumulative impact so far, right? That's what you're supposed to, of course, do as a part of this consideration, right? Of course, the differences arising at between the balance sheet and the comparative years would be brought in, and the changes would be reflected as an opening balance sheet impact, and then of course the comparative year impact done in the same manner, right? They're all being accounted for as a part of this changes in the accounting policies there. Okay, let's have a look at this question as well. What if there is an impracticability of retrospective application? We talked about it briefly, but still let's have a look at it. It says that Good Group is in the business of computer accessories. The company has been preparing its financial statements under Ind AS since 2016, the incorporation date. It follows the FIFO method, but in 2021, it wants to move to weighted average as it reflects better matching of cost with the revenue. Other companies are also following weighted average method, and that's where it becomes a more reliable and relevant information. So there is a genuine reason of changing the accounting policy, right? The moment you say changing in accounting policies, we talk about a retrospective change, right? It says also in year 2021 there was a major accident recognized and all accounting records were lost, right? It is also understood that there's no possibility of recreating the records, and it's impracticable to calculate the cumulative change or cumulative impact of the policy change at the start of 2021. The question is, how should it be accounted for, right? So while we say retrospective as a rule, the practicability is a question now, right? So in that context, while we are expected to go retrospective, we are saying that if it is impracticable, then you apply the new accounting policy from the start of the earliest period, which is practicable. Okay, since any records prior to 2021 have been lost and you cannot do anything about it, you would start applying it from 2021 and onwards, right? Which means no changes in the earlier financial statements, but disclosures have to be given that you cannot go back, and this is the starting date where from you're moving from a FIFO to a weighted average method, for example. All right. Okay. Now, specifically, there could be instances where we need to be very, very comfortable understanding that these instances would not result a change in accounting policies. For example, in case there were events or conditions which were absolutely different, from what's happening now. So a change or an application of an accounting policy would not mean that there's a retrospective change. So it's not going to be considered from that perspective. Similarly, any such events or conditions which were not present at all or they were immaterial. So there are both typical examples, although conceptual, but we have a couple of examples to understand that, right? It says, for example, Estate Limited has multiple properties which it uses in the operations of the company. one such property has been reclassified as investment property. And while under Ind AS 16, the company was following revaluation model. Of course, we understand that under Ind AS 40, only cost model is permissible, right? Now, is this change a change in accounting policy? Well, we say, no, it's not, because this aspect of revaluation model was only applicable to the property, plant, and equipment, and Ind AS 40 prohibits such kind of a recognition. So the change is purely coming because the usage itself is different entirely. In substance, the usage was never there. So in that case, it cannot be considered to be a change in accounting policy. All right. Let's have a look at another scenario. It says that Alpha is in the hospitality business. The company has multiple hotels across various locations. Along with the rooms, it also provides significant ancillary services. And these are accordingly, referred to as a property, plant, equipment under Ind AS 16. Now, it says that during the current year, Alpha acquired another hotel and it has been outsourced, and therefore Alpha is taking a passive role. Now, is this going to be a change in accounting policy? Well, the point is that the new hotel would meet the criteria of investment property, which is Ind AS 40, right? While the earlier hotels would fall within the category of Ind AS 16. Now, such kind of a transaction does not mean a change at all in the accounting policy, because the transaction that has been, that has come into the picture was never into existence, right? It does not accordingly represent any change in accounting policies whatsoever. Okay. Finally, in this particular section, we want to talk about the disclosures. In case you are changing the accounting policies, you need to talk about the changes if in case it is in lines with the transition provision. Likewise, you need to bring the changes with that impact also on the basic and diluted EPS, where Ind AS 33 earnings per share is applicable, right? Likewise, also the amount of adjustments which is pertaining to the previous reporting periods, right? That's what it is. In case the application is not practicable, in case the retrospective application is not practicable, then you need to explain the circumstances and descriptions of that. Again, you don't have to repeat these disclosures eventually. In case of a voluntary change, what is the impact of the change on the current as well as the previous period, right? Or for that matter, what would have been the impact if it were, impracticable to determine, or it might have, let's say, on the future periods also. In that case, the disclosure is required to be given with respect to why do you believe that change is going to result into a more reliable and relevant information, and also the disclosure required for the current and the earlier period for the amount of each line items there, right? Finally, amount of adjustments before these were presented, and in case again, in the same thought process, in case retrospective application is impracticable, then there are circumstances and descriptions of that. Now, also importantly, when there is a new standard which is issued but not yet effective, right? So, and you're not applying it either, you need to explain that part, that while the standard is in place, but you haven't started applying it yet. So explain that part, and importantly, also give an estimate of if had this standard become applicable, then what could have been the consequences of that as far as your books are concerned. Okay, that's broadly the coverage that we have done. So just to quickly revisit, we say yes, accounting policies can be changed either as a compulsion or as a choice. Both the cases we go retrospective unless there are transitional provisions as provided under the Ind AS, right? Thank you very much.